Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known as Mr. Valuation. I'm really excited about my first video for 2022 as we enter the new year. But before I get into the video, I hope everyone had a great holiday, as I did. I had a nice little vacation, thank you. I really enjoyed it. And I'm wishing everyone a happy new year and a prosperous new year coming up. Now, in that light, one of the things I wanted to talk about here, this is my Subscriber Request Tuesday series that I've been doing now for some time. And I've been asked to talk about insurance companies, specifically MFC and Prudential and a couple others. But, as I was thinking about preparing this video, I got thinking, one of the things that the Fed's talked about predicting interest rates, they might even be raising interest rates 2 or 3 times this year. And so I got thinking, well, what would that really have to do to insurance companies? And then I got thinking about the market in general as we enter 2022. The market's actually very high. So I'm going to be talking about the state of the market, the level of the current market, the level of the insurance industry, the life and health industry especially. I'm going to cover some Canadian companies and U.S. companies, I might add. But what's interesting is that in a rising interest rate environment, that could actually be a catalyst that could be the start of an ultimate correction, which we haven't had now for some time, and I'll get into more of that here in the video. But it can also be beneficial to the insurance industry, and I'll talk about that some more too. So let's go ahead and go into my FastGraph research tool, and let's start off by looking at the S&P 500 and its current valuation. Now, as you look at these graphs, if you're not familiar with them, those of you who might be new to the channel, what we do is we plot earnings with the orange line here. We plot stock price, weekly stock price with the black line. And the idea here is that you'll notice that stock prices ultimately move where the company's business moves, in this case, the S&P 500. And so the normal trading range, if you will, or the normal valuation of the market is somewhere between this 15 PE ratio, which is represented by this orange line, and the 18.4 or 18-ish PE ratio is represented by the blue line. Those are normal valuations for the market. And as you can see, the market trades within those ranges most of the time. It steps out of it on the downside during the Great Recession of 2008. It was outside of it coming into the recession of 2001 until it corrected. And now it's outside of it again as, 2020 and 2021 ended. And of course, we had the pandemic of 2019, the great COVID pandemic, I call it, where the market actually did correct and came back into fair value, which, as it turned out, would have been a really good time to be buying an index fund. But here's the thing, the market enters 2022 now very, very vulnerable. I'm going to hone in on this a little bit just to point out that there's a significant amount of potential downside to the market over the next couple of years. If the market were to revert back to a 15 PE, we could see approximately a 30% devaluation of stocks over the next couple of years if the market, and when the market reverts to the mean. I believe it's eventually going to happen as it always did before. So my point is this is a very high valued market right now. And the key point is that if the Fed starts raising interest rates, that's a catalyst that usually brings stock prices down. It's usually bad for the market. Cuts in interest rates usually are positive and beneficial for the market. But let's talk about the insurance industry a little bit here, because that's going to be the primary theme of this video. According to Investopedia, the effect of interest rates on insurance companies is something that is really, it may be uncertain on a specific company. Let me read this and read the quote to you. Historical analysis shows that the overall trend is for the profitability of the insurance sector to increase in an environment of rising interest rates. Insurance companies, issue premiums for their product, and then they invest those premiums into bonds, and they use that premium to generate their profitability. So it says in an environment of rising interest rates, the overall price-to-earnings ratios for insurance company stocks usually increase in fairly direct proportion to increases in interest rates, close quote. Now, the point I'm trying to get at is interest rates will be generally bad for the market and could bring the market down. So, is insurance a defensive sector? Now, I'm going to be looking at several insurance companies here. I'm going to be looking at 4 companies in the United States and 5 in Canada. And these are all a certain criteria that I looked for here. I wanted to talk about very high quality insurance companies. I look for A- or better, all investment grade in the A category. The lowest category of A- all the way up. And I got 2 or 3 in the A plus category, a couple in the A category, and a couple in the A minus category, but they're all extremely, high quality investment grade insurers, if you will. I'm going to be looking at Aflac, MetLife, Prudential, and Principal Financial Group in the U.S. And then in Canada, I'm going to be looking at Grest-West Lifeco, IA Financial Group, Manulife, and Power Corporation of Canada and Sun Life. Now, what I'm really trying to get across here is, and I'm going to start by looking at Aflac here for you, is that where the market, as I showed you a minute ago, is very, very high, the valuation of the market is on the really upper side. Insurance companies in the generally dropping interest rate environment, and maybe that was why it happened, but the valuations of insurance companies have been very low. And Aflac is a good one to kind of set the precedence what I'm talking about. Let's say through the 2001 recession and the 2008 recession, Aflac was not unusual to command 19 and 20 multiples, 18 to 20 multiples. But as interest rates dropped and as the financial crisis hit, things changed quite a bit. So if I shorten this time frame here, I want you to note now that the valuation on insurance companies, Aflac specifically, as I'm looking at here, was really significantly below historical norms. The average price earnings ratio for Aflac has been about 10.37. That's the blue line on this graph. And you can see that's been a very good, proxy for value on Aflac since the recession of 08 and 09. So anytime you could buy Aflac below 10 times earnings, it was a good buy. When it got above 10 times earnings, even though it was still below the normal PE of 15, which it ultimately used to trade at, back as I showed you in the beginning, when it even traded at 20 multiples, so it's trading at about half its normal valuation. The point is, the values of these insurers are very, very low in this dropping interest rate environment. And if Investopedia is correct, in a rising investment environment, that might be the incentive or the catalyst to move them back into the higher valuations. So that's an interesting reason to look at insurance companies. Now, one thing about them, they're all very, very similar, as I'll show you, but they're different at the same time. But you're going to see this low valuation across this whole sector. Now, other criteria that I use to establish this besides A-rated or better, or A-minus rated or better, I wanted to find dividend growth stocks in this sector that have dividend yields over 2.5%. And they all meet that criteria, as you'll see. Aflac's one of the lowest yielding of the group that I'm showing you here. And Aflac is also one that's actually recovered pretty substantially since COVID, of course, but it's moving back into alignment with that 12 or 13 PE. Remember, since, for the last 15 years, that normal PE has been closer to 10, which is about what it's trading at now. The blended PE is 9.89 that yields 2.75% interest. But last I looked, the stock was up pretty strongly today. Now, there's a couple other things I want to get across as I'm showing you this. It's up 2.5% today as I'm doing this video right now. But the point I want to get at is that I want you to note that when you're evaluating investments, you should really be cognizant of what you're buying and, what the characteristics of it are, how the market's been valuing it, and how the company has performed as a business. These are all factors that you want to take into consideration. And again, I strongly want to point out how the market, how the price tracks the operating results of the company, but it can do it at different multiples. Recently, for the last decade or so, 15 years or so, insurance companies have been trading at very low valuations since coming out of the Great Recession. That sentiment may change now if we start getting into a rising interest rate environment. And, this would be an opportunity to look at good yielding dividend growth stocks with high dividend yields, low valuations, and give you the opportunity to see both capital appreciation and current income. Now, for example, in Aflac's case, analysts are expecting about 5% growth, but if this were to revert back to a 15 PE ratio, the rates of return over the next couple of years would be in the 20 and 30% range. If it stayed at that normal multiple of around 10 times earnings, the rates of return, would not be quite as good looking at Aflac, and it's one of the worst of the group. But assuming that we get back into these normal multiples, these normal, PE expansion from the 10 multiple to the 15 multiple, there's really tremendous opportunity here. So that's something that a theme throughout this whole video here. So I'm going to now kind of go quickly through these companies, and I want you to notice a couple of things. The similarity in all these companies, the similarity of how the market's been valuing them, and the fact that they all provide different opportunities. And, the key is, would you build a whole portfolio here? Probably not. But if you were looking for income and capital appreciation at a reasonably high level of safety and even maybe a slight hedge against the market, this might be the sector you want to look at. So let's move on And let's look at MetLife. And very similar to Aflac, we see a stock, that traded at higher multiples in the past and lower multiples since. But now this is a lot less consistent than Aflac. That's the first thing I want you to note. So, I actually like Aflac better than MetLife for that reason personally. However, it does offer a 3% yield, but it's a lot more unpredictable. And that 10 multiple has applied here. And again, you can buy it at a 7.5 blended PE with a 3% yield. So this might make it more attractive than, let's say, Aflac. It moves back to that 15 PE ratio. Once again, you've got very high rates of return possibilities if we get that reversion to the mean and, resulting in PE ratio expansion. But even based on the normal multiple, this gives you a little better numbers than what we see in Aflac. So MetLife may be a better choice today than Aflac. All right. But I do, again, want you to note that this has been a less consistent company with less growth. And, there are times when the company doesn't grow at all and then times when it grows faster. The average, since 2012 has been about 4.85%. And again, the market's forecasting similar rates, actually 8%. But again, that's distorted by a very high growth rate this year, followed by a negative growth rate next year, and then about a 9% the following year. So always when you're doing these maths, the number is interesting and very important to look at, but also you want to look at why the number happened, where the number came from. That's MetLife. Moving on, we have Principal Financial Group. A little better growth and consistency characteristic. Very similar to Aflac, we see very high valuations. Great recession came, minor dividend cut, low valuation. And that's another point I want to make now. When you're looking at these companies, I do want you to note that the dividend records since they came out of the recession have been very, very good. So, once they kind of got their legs under them after the recession, the stock still traded at this 10 multiple, as I talked about. But look at the dividend. It went from 50 cents to 55 to 70, all the way up to 244 last year. That's still an estimate because we haven't got the final numbers yet. It's expected to increase again next year. The dividend yield is 3.5%. The PE is about 11.7. The company's forecast to grow at about 15% going forward. So it's one of the higher growth. And if it does that and interest rates start rising and that raises the market's optimism about the sector and the profitability of the sector, and if Investopedia was right and the price earnings ratios will increase in direct proportion to the drop in interest rates, this could be a tremendous opportunity to invest in Principal Financial Group. So, it's got really good potential going forward. And even at its normal multiple, and again, it still gives you a decent rate of return going forward. So the point is, I don't think the risk is very high here. And I think the upside is extremely high, especially if these stocks revert to the mean, valuations that have been more normal to the industry. And then the last U.S. stock that I'm going to cover here is Prudential. And again, it's a moderately inconsistent, semi-quasi-cyclical type company if you try to quantify that, because it's got growth, but yet it's cyclical. It actually has 11% historical long-term growth. It was very consistent coming into the recession of '08. Since that, it's been, somewhat cyclical, if you will, but yet if I measure the growth rate, it's been 11% on average, but, it's done it with peaks and valleys. But once again, we see about a 9 or 10 multiple, in this case, 8.96. The math always has to be done precisely, but when you change the time frames, the math changes because you're looking at different numbers here. So an 8 or 9 multiple for Prudential or a 10-ish multiple for Prudential has been the norm. If we get rising interest rates, could, instigate the market to start, valuing these stocks at more normal type PE ratios. And once again, we would have very, very, almost unbelievable numbers for these guys. And that potential is there, is what I'm really trying to point out in this video here. In other words, you're looking at a very highly valued market that's vulnerable to interest rate drops. And then you're looking at a very low valued industry or sector called the insurance sector in the U.S. that is, undervalued and could actually start seeing PE ratio expansion, coupled with any growth. And they all have good dividends, 4.18% yield on Prudential right now. So if you're looking for dividend income, these could be the tickets. And they've increased their dividend very substantially. These are just the quarterly numbers, for the years. But, you can see that the dividend has increased every year since coming out of the recession. So they got a nice dividend streak going on. And again, you can can look at these things for both income and for capital appreciation. Now, moving north to our neighbors up the north, look at some of the Canadian companies. And I'm looking at these Canadian stocks in Canadian dollars now. These are, it's CAD as Canadian dollars, but they're very consistent. Grest-West Lifeco has been a very consistent performer, offers over a 5% dividend yield. PE ratios are low. Again, the valuations of these insurers, just like we saw in the U.S. counterparts, has been very low relative to the overall market. So these guys do provide that same kind of opportunity, but notice how the price reacts to the business results. Always note that, and note the nature of the beast here as you're looking at these investments, if you will. So there's Grest-West Lifeco, very attractive looking. IA Financial Group, Transamerica in the U.S., I believe is who they are. They've had a very interesting picture here because you're going to see this now in several of the Canadian insurers where they got real consistent. They struggled through the recession that occurred here in the U.S. They kind of got their legs underneath them, if you will, but then they've been growing very consistently at very high rates, subsequent to that. And they've increased their dividend at, really good rates at, double-digit rates during this time frame too. So once again, you have this opportunity for these stocks to move back into a 15 PE ratio, and you have just substantial rates of return. You got a 2.68% dividend yield that's increasing every year. Moving on, you got Manulife. This is one of the ones that I was really requested to do. And I think it's a very interesting picture. You can see the growth of the insurance company between these two recessions. They got really, hit hard by the Great Recession and the financial debacle. Since then, as I showed you earlier, they got their legs underneath them, but the market has been valuing them at a very low valuation. So let me shorten this time frame to where we see now, and you start seeing a 9 or 10 PE multiple. So you've got real low valuations, a 4.65% dividend yield, dividend growth potential, and really attractive upside potential in these stocks. I mean, where the actual rates of returns could be unbelievable if we get that reversion to the mean. And by the way, any increase in PE ratio will be beneficial. If the PEs just, move back to the 10.5 PE, as you see here, we've got 50% annualized total rates of return, including dividend income. So there's a lot of opportunity, I believe, in this sector. And that's one of the points I wanted to really get across here. And then you look at Power Corporation of Canada. I wanted to show this one because it's really been kind of a flat grower. It does offer a 4.25% yield. It has recovered very strongly with very strong earnings growth expected for 2021. Forecasting is expected earnings to be flat to down next year, maybe up slightly the following year. But once again, if we get that reversion to that 15 PE ratio, we've got very, very high rates of return and a 4.28% dividend yield while you're waiting. We don't have quite the dividend growth consistency that we saw with these other companies. There are times when this company has frozen its dividend, and at other times when it's increased it dramatically. So one of the things that I don't like about this company is I don't like the predictability factor. It's not as predictable and as consistent as some of the others that I've, already shown you. And then Sun Life, very similar to Manulife, where you had, really good, consistent growth. The multiples are up there in that 15 PE ratio range. They really struggled coming through the recession and out of the recession. But since that time, they really kind of got their act back together. The stocks have been growing at 8 or 9%, trading at around 10, 11 times earnings, 11.5 times earnings. We've got a really neat opportunity with a 3+% dividend yield. You could see rates of return going up to 44%. Now, let me talk about this a minute. When I'm saying this, you may not be picking up on it. What I'm saying is if these companies earn the money that the analysts are expecting them to earn next year, and if their PE ratio increases from the current 11.6 or 7 up to 15, you get slight PE expansion with modest, well, in this case, 10% growth. That's talking about you could have a total return annualized of 44% in the next year in this stock. And going out 2 years, it would average about 27%. The opportunity here is in the valuation. Now, the long-term growth potential of all these companies is also very good, but I'm trying to use more conservative estimates here and just stick with the short-term numbers, and you've got all this upside where these prices could be rising dramatically if we get the PE ratios to increase, as Investopedia implied in their estimation of what would happen to insurance companies if interest rates rise. This could be a sector where you've got plenty to shop in. I've shown you 10 companies here, basically, in the U.S. and Canada that are very attractively valued in a very highly valued market. It's a great opportunity. They're all high quality companies. They have very reasonable debt to capital ratios. In the case of Sun Life here, it's only 15%. It's A+ rated. You got a lot of opportunity here to be looking at. So this is a sector that you're going into 2022 and the possibility of seeing, interest rates rising to fight inflation in the U.S. That could really help the U.S. companies. And I imagine that will work the same for the Canadian companies. So anyway, this has been Chuck Carnevale saying thanks for watching. Glad to be back. Let's look for a prosperous 2022. But the key is, let's navigate it intelligently. Let's recognize where we are, where we might be going. Let's look for pockets of value, as I've shown you, I believe, the insurance company, a lot of other financials as well, as I'll be covering in future videos. Anyway, if you like this video, give me a like. If you want to get more videos like this, ring the bell so you can be notified of future videos. And if you haven't taken a look at Fast Graphs, the new Fast Graphs is functioning pretty well now. We're still in beta, but we're getting it really solid. We got some new enhancements coming out, so you might want to take a look at taking our trial on Fast Graphs and start your new year where you have the right tools to be able to invest properly and be able to protect yourself as well as position yourself to make some money. Anyway, thanks for watching.